The quickening the pace strategy has really got off to a fast start this year. We've been focused on organic growth, replications. There's a lot of activity going on in the business, which compares to a year ago when we were making some big acquisitions in China and in Turkey to create the 5013 previous strategy, which is now complete. In terms of the replications, we've been very busy in replicating two of our key brands, and we're the first organizer to be taking brands outside of Turkey and outside of China. For example, we've taken our GZ Auto brand out of China, and we're launching that next year into Indonesia and into Turkey. And with Zuchex, our houseware brands, we're taking that into Indonesia and into Dubai next year. We are very pleased with the financial results in the first half, which is the quieter half of the year. We've had good revenue growth, up 8% like for like, very strong growth in both our adjusted profits and adjusted earnings per share, dividend up 5%, and the real drivers for the good performance has come from the emerging markets, which overall were up 13%, with particularly strong performances out of Turkey and China. In some of the emerging markets, there's been some political disturbances, and for us, particularly Turkey, we ran one of our major events during the disturbances and we had no impact on our revenues, although our visitors were slightly down. Going forward, we're not seeing any impact at all. In terms of individual performance, we were very pleased with Ascensor, the major lift exhibition in Europe, which had revenues up 35%. Also, very pleasingly, Dubai has bounced back quite strongly, and in particular, our education event has shown very strong growth. In America, our medical business continues to go well, in particular, the online education. And also for the second half of the year, we've got the first edition of our new acquisition in Indonesia, the infrastructure show, which is building well. The only real concern that we have at this moment in time is the macroeconomic situation in Europe. Our French business has performed as expected this year, which has been flattish, but it's a small part of the overall business, less than 5% of our profits. But as far as we're concerned, we're focused on execution and continuing to give good customer service to our clients, and that's what's going to keep driving our profits forward.
Very good revenue performance with growth coming in from acquisitions, biennial shows and good underlying organic growth at 8%. You can see that coming through into profitability, where we have a big increase in profits and also in EPS. In terms of cash, we've got a very strong operational cash performance, 8.9 million operating cash coming in. Now, some of that comes from the big shows in the second half of the year, but actually in itself, really good performance for the first half. That helps fund some of the payments for the acquisitions and deferred consideration, and we ended the half year with net debt of 29 million, which is gearing around 1.5, which is bang in line with our expectations. Bookings for the full year are looking very strong at 12% up versus the previous year. On the large shows in particular, looking very, very strong. The Dubai Air Show is up high teens versus the previous edition. Label Expo Europe is up around 10% versus its last show. So good performance on the big shows. The US business overall has got good bookings for the second half of the year, and so it gives us good confidence as we move into the larger part of the year that overall the bookings is a very strong position.
In terms of the medium-term outlook for the business, we're very positive, given the repositioning of the portfolio to be more focused on emerging markets. We continue to see good growth in Asia, in the Middle East and in Turkey, supplemented with very strong growth in our medical business in America. So we're feeling very positive, and the numbers coming through for the second half are backing up that optimism.